Hello and welcome back. Welcome to Chapter 4, the accounting cycle. We, throughout the past week in Chapters 1 and 2, and then of course just recently in Chapter 3, all of these processes we've been discussing amount to what we call the accounting cycle. Starts with journal entries, goes through the process, goes through closing process, goes to adjusting entries, and then eventually we close everything out. The accounting cycle, right? Every year we go through the accounting cycle. So let's talk about the accounting cycle. What is it? How does it help us? At the end of the accounting period, we flow the data. What do we mean by flow the data? We close out our temporary accounts from our income statement. It shows up on our retained earnings statement, which shows up on our balance sheet. Okay? And we'll talk more about that. At the end of the accounting period, we go through our adjusted trial balance, our unadjusted trial balance, and our adjusted trial balance. And that gets us to the end of the accounting cycle. We get through this stuff because it's not as helpful. Let's talk about this. Okay, how the flow of accounting information. There's a couple of spreadsheets in here that are somewhat helpful, but probably not as helpful. The idea here is that we see the flow of accounting information. Look at what we just talked about in the previous chapter, in Chapter 3. We talked about the unadjusted trial balance and the adjusted trial balance and adjusting entries. At the end of the accounting cycle, we transfer the adjustments from the income statement and the balance sheet to the balance sheet. We transfer the equities to the statement of equities or statement of retained earnings. And then that transfers to the balance sheet. This is the flow of accounting data, flow of accounting information, which is all a part of the accounting cycle. On the income statement. On the income statement, we have our revenue and our expenses and our net income. How do we get to net income? You take your revenue, total revenue, minus all of your expenses. Revenue minus all of your expenses. Revenue minus expenses equals net income. That's the income statement. A very simple form of the income statement. This is from a service business. How do you know it's a service business? It says fees earned. If it was from a retailer, it would say sales revenue, and then it would have cost of goods sold minus cost of goods sold equals gross profit. That's how we know it's a difference. The income statement is prepared directly from the adjusted trial balance at the end of the accounting cycle. With the fees earned, the expenses in the income statement are listed in order of size. So if you're ever wondering, who determines this order of the expenses? It's determined by the order of size. The amounts. The higher the amount is usually on the top. And miscellaneous is always at the bottom. Miscellaneous always at the bottom. Doesn't matter the size, but miscellaneous always at the bottom. I don't like to use miscellaneous expense in accounting. We use miscellaneous expense in accounting if we don't know what it belongs to. Okay? You might get a receipt and it's like, yeah, I don't know. And it's one of those rare things. If it's rare, it doesn't happen frequently, and you don't know what it belongs to, then we use miscellaneous expense. I try never to use miscellaneous expense because I don't like having miscellaneous expenses. I like knowing what my expenses are. Stockholders' equity statement, also known as retained earnings. We have our common stock and our retained earnings. How is it all figured out? How's the balance figured out? You take your beginning balance plus any issued common stock plus your net income minus your dividends equals your ending balance for net income. Oh, I'm sorry, for retained earnings. So again, beginning balance plus issued common stock plus net income minus dividends equals ending balance for your statement of retained earnings, or in this case, statement of stockholders' equity. Statement of stockholders' equity is normally presented on the statement of stockholders' equity report, and they show the balances of common stock and retained earnings at the beginning period, and then of course at the end after you pay out any dividends. So beginning balance plus issues of common stock plus net income minus dividends equals your ending balance for the statement of stockholders' equity. Entries in each row are added across to the total column. It's really simple. About the balance sheet. The balance sheet, as you recall, shows assets, liabilities, and equity. Now, we further classify the difference between current assets and long-term assets, or current assets and property, plant, and equipment, fixed assets. Same with liabilities. You have current liabilities, long-term liabilities, total liabilities. Stockholders' equity, you have common stock, retained earnings, total stockholders' equity. Here's how it works. Current assets, that's cash, accounts receivables, inventory, also known as supplies, and prepaid insurance, which is an asset account, which we talked about in Chapter 3. You add up your current assets to get total current assets. Then you look at your property, plant, and equipment. Those are your fixed assets. Land plus office equipment minus depreciation. Your asset minus depreciation equals book value for that asset. So land plus office equipment, $1,750, equals total property, plant, and equipment. To get your total assets, you take your total current assets plus your total property, plant, and equipment, also known as fixed assets, to get your total assets. In this example, $29,495. Then, of course, you got to do the same thing with your liabilities and equity. Liabilities, current liabilities, accounts payable, wages payable, unearned rent. And then if you had other liabilities like long-term liabilities would be notes payable. Those are like loans that you took out from the bank, notes payable. Another long-term liability would be a mortgage, notes payable. Anything longer than 12 months is called long-term. So you add up your current your current liabilities and your long-term liabilities, if you have any, to get your total liabilities. In this example, $1,390. Then we take our common stock plus our retained earnings to get total stockholders' equity. Remember the accounting equation. Assets equals liabilities plus equity. So we take our total liabilities plus our total stockholders' equity to equal total liabilities and stockholders' equity, $29,495. Oh yeah, that's the same as your assets. Assets equals liabilities plus equity. $29,495 equals $29,495. That's why we call it a balance sheet. Balance sheet. Well, one of the reasons why we call it that. Balance sheet is prepared directly from the adjusted trial balance that we learned about in the previous chapter. We begin with cash, assets, and liabilities, and the amount taken from the adjusted trial balance. The common stock and retained earnings are taken from the statement of stockholders' equity. That's where they're found anyway. Balance sheets are organized in subsections, assets and liabilities. Just as we talked about, current assets, property, plant, and equipment, those are all assets. But it's always listed out that way. Every balance sheet's the same exact way. Assets, liabilities, equity. Assets, liabilities, equity. In assets, you'll have current assets, and then you'll have fixed assets, property, plant, and equipment. In liabilities, again, two sections. Current liabilities and then long-term liabilities. Current liabilities, those are liabilities owed within 12 months. 12 months or less. Long-term liabilities is anything greater than 12 months that is owed. An example of that would be a bank loan, or a mortgage, or an automobile loan. Anything longer than 12 months. Current assets, those are assets that you expect to use or utilize within 12 months or less. Remember, the word current, when you hear the word current, it means 12 months or less. Current, 12 months or less. Current assets, we have cash, notes receivable, accounts receivable, supplies, which is also known as inventory, and other prepaid expenses. We expect to utilize these within 12 months or less. That's what makes it current asset. A notes receivable. What's a notes receivable? You might be asking yourself, this might be the first time you're hearing the word note receivable. Note receivable is when the company issued a line of credit to the customer. Line of credit to the customer. An example of this, let's say you're Macy's. Okay, a big retailer like Macy's, and your customer applies for a Macy's store card. Macy's store card. For Macy's, that is a note receivable. It is a short-term obligation for a customer to pay you back. So, note receivable example would be a Macy's store card. Or a store card, right? A store card is like a credit card that can only be used at that store. And so in that case, the store calls it a note receivable. The customer will pay the store within 1 year or less. It's revolving. Oftentimes revolving. That's a note receivable. Property, plant, and equipment. We talked about this a lot already. Property, plant, and equipment, we call those fixed assets. And they include equipment, machinery, and buildings, and land. Current liabilities, these are bills that the company owes to someone else in 12 months or less. These would include notes, the current portion of notes payable. Current portion of notes payable. Accounts payable, wages payable, interest payable, taxes payable, unearned revenue. In this case, unearned fees. These are all current liabilities because we expect to pay them within 12 months or less. Or earn them in 12 months or less. Right? Long-term liabilities greater than 1 year. Example would be notes payable. Notes payable is long-term liabilities. Current portion of notes payable is that portion of the long-term loan that is paid within 12 months. An example, let's say you have a mortgage. Mortgage is for 30 years. It's a new mortgage. You just got it. Okay, 30-year mortgage. That first 12 months of that mortgage, would be classified as the current portion of notes payable. The rest of it's just notes payable, which is a long-term liability greater than 1 year. Stockholders' equity. We know that's the owner's rights to the business. Stockholders' equity would include things like common stock, dividends, retained earnings. Following accounts were taken off of the adjusted trial balance for a company. This is an example. Let's check up corner. I don't want to go through that. Check up corner is kind of boring. I'll give you better examples. The checkup corner examples, they're not that great for this book. I'll show you better examples than that. Okay, we talked about this a little bit. I talked about temporary accounts and permanent accounts. Permanent accounts are also called real accounts. Permanent accounts are the accounts on the balance sheet. Permanent accounts are the accounts on the balance sheet. They are carried from year to year. Permanent accounts, also known as real accounts, are the accounts found on the balance sheet. They carry over from year to year. So for example, on December 31st, when I close out my accounts, I don't close out the balance sheet. Those balances still exist. The bank account is still there. It still has cash in it. So those are called permanent accounts because they carry the balance forward from year to year. Temporary accounts are accounts that we close at the end of the accounting period, which is end of 1 year. Temporary accounts are the accounts found on the income statement. The income statement gets closed out at the end of every accounting period. Okay? Accounting period is each month. We close out those temporary accounts to the statement of retained earnings. So how does it work? We zero out our revenue and our expenses for the beginning of each month. How do we do that? We transfer our net income to retained earnings statement at the end of each month. Okay, or I keep calling it retained earnings. It's also called the statement of stockholders' equity. We take our net income, which is our revenue minus expenses, net income, we transfer that to the statement of retained earnings or statement of stockholders' equity. And that closes out the temporary accounts, which are the revenue and expense accounts on the income statement. Why do we do it? Because at the beginning of every month, you don't have revenue. You don't have expenses at the beginning of each month. You accrue those each month. You don't start with an accrual. You end with an accrual. So that, therefore, at the beginning of each month, on January 1st or February 1st, March 1st, the first of every month, you start with zero. And then you accrue the revenue and expenses over that month. And then at the end of every month, you close out those temporary accounts by transferring them to the retained earnings statement or statement of owner's equity, what's called, through the closing process. We call that closing the books. We do that at the end of every single month. After the closing entries are posted, that's where we transfer the net income to retained earnings. It zeroes out the balances from those accounts, from the income statement. Closing process involves 2 steps. Step 1, revenue and expense accounts on the income statement balances are transferred to retained earnings account. Step 2, the balance of the dividends account is transferred to retained earnings account. The two closing entries required for the closing process are: we debit each revenue account, because remember, when you earn revenue, you credit it. When you close out your revenue accounts, you debit them. That debit transfers them to retained earnings. So you debit revenue account when you close it out, and you credit the expense accounts. When you debit a revenue account and credit the expense accounts, what you're doing is you're reducing those accounts. But you do it for the full amounts, and that's what zeroes them out. But when you debit and you credit them, you need to debit them to retained earnings. And then what that does is it transfers the revenue and the expenses to retained earnings. Debit the retained earnings account for the balance of the dividends account and credit the dividends account for its balance. That's the closing process, closing entries. And that's done after the adjusting entries that we talked about in Chapter 3. Here's the flow chart. Here's what the flow chart looks like. I'm not that big into charts, but sometimes they're nice graphical representations. So we have two numbers, 1 and 2. 1 and 2. Okay. 1, we do that first. Those are the closing entries. We take the dividends. We take our expense accounts, which we transfer to total expenses. We take our revenue accounts, transfer that to total revenue. Total revenue minus total expenses equals net income. We take our net income and we transfer that to retained earnings. Then, step 2, we take our dividends account, transfer that to retained earnings. Just as we talked about in Chapter 3, beginning balance plus retained earnings, beginning balance plus net income minus dividends equals ending balance retained earnings. There might also be some common stock. And here's how the closing entries look. Remember, debits must also equal credits. Here's how it looks. This is the closing entry. We debit fees earned and any other revenue. We debit our revenue, okay? What that does is it reduces the revenue. We credit all of our expenses. What that does is it wipes out all of our expenses. Then we debit retained earnings and we credit dividends. And what you're doing by making those two entries is you're transferring all of that to your retained earnings statement. Using the ledger with closing entries. As you recall from Chapter 1 and Chapter 2, these are called ledger accounts. Ledger accounts. Ledger accounts is a list of shows you the list of transactions that happens within that account. Cash, accounts receivable, supplies, prepaid insurance, land, office equipment, so forth and so on, right? At the end of those accounts, we have our closing entries. For the ones that we close out. Now, after we've made our closing entries and we went through the closing process, then we perform what's called a post-closing trial balance. Post-closing trial balance. Post-closing trial balance is prepared after the closing entries have been made. Purpose of this is to verify that the ledger in the balance at the beginning of the next period is at 0. So to prepare a post-closing trial balance, we take our accounts, we list them out the same way we've done in previous statements. So you got your assets, your liabilities, your equity, and then you have your retained earnings. Retained earnings, as we know, comes from the retained earnings statement, or the statement of shareholders' equity. The debit balance and the credit balance should be equal. They always need to be equal. This is the post-closing trial balance. Okay, so now, once you've done the post-closing trial balance, you've gone through the accounting cycle. Okay, the accounting cycle begins with making journal entries and ends with the post-closing trial balance. That's what the accounting cycle is. Think of it as a list of steps that you complete at the end of each month. That's the accounting cycle. So step one, we record and analyze the journal entries. Remember, journal entry represents a transaction. Right? Step two, the transactions are posted to the ledger. Okay, that's recording the transaction. After it's recorded, it gets posted to the ledger. Step three, the unadjusted trial balance is prepared. We talked about that in the last chapter. The unadjusted trial balance shows us where adjusting entries need to be made. Step four, we make our adjusting entries. Step five, prepare a spreadsheet. I never do that. It's optional. Step five is very optional. I don't do step five. Personally, I don't. It's easier to manage through accounting software. On a spreadsheet, it's nice. It's nice visual representation, but it's definitely not necessary. Step six, the adjusting entries are made and recorded to the ledger. Step seven, unadjusted trial balance is prepared. The adjusted trial balance is prepared. That's after you made the adjusting entries. It shows you that your debits and credits equal. Step eight, the financial statements are prepared. This is where you verify that your income statement, balance sheet, statement of cash flows, retained earnings, which is also known as your stockholders' equity report, are all correct. Step nine, we close out. We make the closing entries to zero out our temporary accounts. In step 10, we do the post-closing trial balance to make sure that our debits equal our credits for our closing entries. And that is the end of the accounting cycle. Any questions on the accounting cycle so far? Just got to think about it in steps, Of course, once more you practice it, the easier it gets. Any questions at all so far? We're okay. All right. Remember, if you have any questions, just go ahead and unmute yourself and ask. Okay, so where are we? Chapter 1, we went through the chapter 1, 2, and 3, and now 4. We went through the accounting cycle. Chapter 1, we learned about transactions. We learned about the accounting equation. In Chapter 2, we learned about debits and credits and how debits and credits impact the balance sheet accounts. And of course, we learned, we did that by analyzing our transactions, recording into the general journal. In Chapter 2, we also learned how to post to the general ledger. In Chapter 2, we also learned how to prepare an unadjusted trial balance, where our total debit balance equals our total credit balance. In Chapter 3, we learned about the adjusting entries. We prepared adjusting entries, posted it to the ledger, then we did an adjusted trial balance. We did the adjusted, we analyzed the entries. We didn't do the spreadsheet. Spreadsheet's very optional. We posted to the ledger, then we did the adjusted trial balance. In this chapter, we learned how the financial statements are prepared through that process. We learned the closing entries, and then we prepare the post-closing trial balance. Good so far, right? Yes?
Yes, sir.
Awesome. Cool. Thank you. Very, very good. I'm going to show you a quick example of the accounting cycle. This is for a consulting company. Consulting company, as you know, is a service business. A consulting company is a service business. What type of consulting do they provide? We don't know that. But we know that they're a consulting business. They probably do small business consulting or something like that, right? So for this company, we'll show you what their chart of accounts looks like, the types of journal entries that they make, the unadjusted trial balance, and the spreadsheet that they produce. We'll also show you the adjusting entries, adjusted trial balance, financial statements, post-closing entries, post-closing trial balance, and the ledger. Remember, all of these are steps in the accounting cycle. So I'm going to illustrate that to you through an example. So first thing, I'll show you the chart of accounts for this company. As I said before for the chart of accounts, I mentioned this in the chapter 3. The chart of accounts shows us assets, liabilities, and equity accounts. They are listed in order of liquidity, and they are organized by the type of accounts. And they also have what we call a reference number. The reference number is 2 digits. We know if it's an asset, it starts with 1. 1 is cash. 1 2 accounts receivable. 1 4 inventory. 1 5 prepaid rent. 1 6 prepaid insurance, so forth and so on, right? These are all asset accounts. How do I know? They start with 1. And of course, I know that they're on the balance sheet as an asset. Next is liabilities. Starts with a 2. Accounts payable, salaries payable, unearned fees. Those are my liabilities. 3, we have our equity accounts. That should say common stock, not stack. Oh boy. Sometimes the textbook doesn't know how to spell, right? Retained earnings, dividends. Number 4, those are our revenue accounts. In this case, it's fees earned. Why fees earned? Because this is a consulting business. It's a service business. If it were a retailer, it would say sales. Right? Sales revenue. 5 is our expenses. Salary expense, rent expense, everything expense, right? That is our chart of accounts for our consulting business. Everything starts with a chart of accounts. Every business has a chart of accounts. Go ahead.
This number, this top before all that you just showed us.
I'm sorry?
Yeah, this is in our book, or this just how this look for you on yours, or that's the same age. I see it.
Yeah, it's a business. So for this example, this is a consulting business, and what I just showed you is the chart of accounts for that consulting business. And you'll be able to see that, David, also in the throughout the book. And we see that though that chart of accounts that I just showed you, those reference numbers correspond with the reference numbers for each account through the general journal. So the second step of the accounting cycle, as you know, or the first step of the accounting cycle, as you know, is making the journal entries. And every month, the company makes their journal entries. This first transaction looks like they received cash. They received. They had an increase to accounts receivable because they probably sold on account. Looks like they may have bought some inventory. It looks like they purchased some office equipment and they issued common stock. I got all that from that first journal entry. Second journal entry, they paid their rent for next month. Prepaid rent. That's how I know it's for next month. They also prepaid their insurance on April 2nd. April 4th, they collected, they sold something. They sold the service. Debit, cash, credit, fees. So forth and so on, right? And each that's why I like accounting. That's actually what got me interested in accounting in the first place. Is you look at this list of transactions, these journal entries, and you think to yourself, oh, something happened here on these dates. A transaction has occurred. A business transaction has occurred. And there's a story behind each transaction. For me, that's what got me interested in accounting in the first place. You think about those types of stories, and it's interesting. It's interesting for each business. That's also why I like auditing, because I look at a business and I'm like, oh, that's interesting. Okay, so first step, you make your journal entries onto your general journal as second step. Then we see on the 30th, end of April, we see this little break. What does a little break represent? It represents where your adjusting entries begin. So we have some adjusting entries: miscellaneous expense, the cash fees earned, accounts receivable, fees earned, dividends, cash. We prepare the next step of the accounting cycle is we prepare the unadjusted trial balance for this company. We listed out all of our assets, liabilities, equity, revenue, and expenses. You list all of those out in that order, and you list out their balance. Now remember, assets normally carry a debit balance. Liabilities normally carry a credit balance. Your equity accounts normally carry a credit balance. Dividends normally carry a debit balance. Dividends normally carry a debit balance. Your revenue normally carries a credit balance. And your expenses normally carry a debit balance. Once you know if it normally carries a debit or a credit balance, it becomes a little bit easier to understand. This is that optional step in the accounting cycle to prepare a spreadsheet. I think it's step 5. I never do that. I just don't. I don't know why I don't. But this company does. And so what they did is, what that spreadsheet shows us is you have your unadjusted trial balances. Then it shows you the adjusting entries that you made to the respective accounts that needed adjustments at the end of that month of April. Then it also shows you the adjusted trial balance. And so what you realize at the bottom, where your balances are, line 27. Your debits equal your credits. Debits equal your credits. Debits equal your credits. So I guess that's one of the reasons why it's nice to show that, the spreadsheet. Adjusting entries that were made, and these entries match exactly what you see here. These are the adjusting entries we've made at the end of April, for the month of April. Insurance expense, prepaid insurance. This means we consumed a month worth of insurance. Supplies expense, the supplies. We sold some inventory. is what that, or we used some inventory. Depreciation. We accumulated depreciation for the month of April for our fixed assets. In this case, office equipment. We accrued salary. Salary expense, debit, credit, salaries payable. We consumed rent that we prepaid at the beginning of the month. We prepaid April rent. We recognized April rent at the end of the month. Same with revenue. We recorded unearned revenue during the month. At the end of the month, we were paid and we performed the service. So debit, unearned revenue, credit, revenue. Then we perform the adjusted trial balance. Debits equal credits. We list, again, your assets, liabilities, equity, revenue, expenses. Then we prepared our financial statements. We took our income statement and closed it out through net income. Transferred net income onto our retained earnings, right? Beginning balance plus common stock plus net income minus any dividends equals ending balance, retained earnings. That retained earnings ending balance then gets transferred to your balance sheet. This is remember, a balance sheet is a snapshot in time. Which is representative of your assets, liabilities, and equity. And of course, any adjustments that were made at the end of that month to prepare the balance sheet. Office equipment, we had some depreciation for that office equipment. That was an adjusting entry that we made. We also made the adjusting entries to close out our temporary accounts, which is why our retained earnings is $12,300. Oh, and of course, we made some adjusting entries for liabilities in our transactions. After all, you have prepared your financial statements, income statement, balance sheets, and your statement of retained earnings. You then prepare your closing entries. Your closing entries, debits and credits to close out your temporary accounts, to close out your dividends. And then you do your post-closing trial balance to make sure that your debits equal your credits based off of the post-closing entries. And then, of course, everything gets transferred to your ledger. This is a nice itemization of your ledger accounts. And that is the accounting cycle. Any questions on the accounting cycle? We're almost done. We're just going to do a couple quick ratios and then we're done. Good? Okay.
Yes.
Wonderful. Thank you, Erica.
Professor, sorry, I have another class at 1:40, so you think we'll be done by 1:40? Or...
Oh, yeah, definitely. Yeah, we'll be done in the next 5 minutes.
Okay.
Yep. Thank you. Okay. Quick, a couple of ratios I want to talk about. We use ratios in accounting to understand the financial performance of our business. We want to make sure that our company's healthy. How do we do that? We perform a couple of ratios. One is called a liquidity ratio. These are types of ratios. Liquidity. Liquidity means how quickly can I convert my current assets into cash? How quickly can I sell inventory? How quickly can I collect an accounts receivable? That's liquidity. How quickly can I do those things to convert it into cash? That's liquidity. Liquidity measures the company's ability to turn things into cash, which helps the company to then pay its debts. Solvency. If a business is solvent, that means the business has the ability to pay all of its debts. If a company is solvent, it has the ability to pay all of its debts. Two financial measures for performing, evaluating the company's short-term liquidity and solvency. We call these the working capital ratio and the current ratio. These are very simple ratios. Working capital. Working capital is the axis of current assets over its current liabilities. This gives the company flexibility to make investments, to make good decisions, right? Working capital. It's very simple computation. You take your current assets minus your current liabilities. That equals working capital. Current assets and current liabilities, as you know, are found on the balance sheet. A positive working capital implies that the business has the ability to pay all of its debt. All of its current debt, I apologize. Current debt. An example of that. Our company has current assets of $7,745. Our current liabilities are $1,390, which tells us that we have a working capital of $6,355. I could use that money to then reinvest into the company. The second ratio that I'd like you to remember is called the current ratio. This expresses the relationship between current assets and current liabilities. To compute this ratio, it's very simple. You take your current assets divided by your current liabilities. Higher ratio, the better. Okay, the current ratio for our company. Our current assets are $7,745. Our current liabilities are $1,390. You take your $7,745 current assets divided by current liabilities, $1,390, to give us a current ratio of 5.6. The higher, the better. And that is the end of Chapter 4. Are there any other comments, questions, or concerns that I can help to answer for you at this time before we call it a day?
No, sir.
Wonderful. Thank you, Michael. Anything? Anyone at all? You all still with me, or did you go to lunch?
Still here.
Okay, cool. Wonderful. Okay, so I'm going to go ahead and stop this recording. I appreciate your time. As a recap, what is due this week? Chapter 3 quiz. Chapter 3 quiz due by Sunday night. Chapter 4 discussion board. The discussion board requires a minimum of 1 to 2 paragraphs, full paragraphs, including citations and references for the initial post due by Thursday night. Then you need to respond to 2 or more of your classmates with 1 full paragraph minimum with citations and references. That is how you'll earn the full 5 points for the discussion. Discussions are very important. Please make sure you participate. Remember, there are 4 discussions in this course. Each discussion is worth 5% of your total grade. So please, it's very imperative that you participate in the discussions. And as always, if you have any questions, comments, or concerns that you need me to answer, please feel free to call me, email me, set up office hours with me. I'm here for you, and I appreciate your time. And, of course, stay safe, wash your hands, do the right thing.